I want to talk about the company's annual report. You are looking at a company annual report for the AmerisourceBergen Corporation. It contains some promotional information about the company, a letter from the president, a list of the board of directors and the corporate officers and so forth. It is issued annually by a company to update the shareholders on the status of the corporation, occurred with the company during the past year, new products that have been developed, maybe acquisitions they have made, things of that type. And then it also has the financial component. And that's the part that we're going to be basically interested in this particular course. You'll see the auditor's opinion, the balance sheet, the income statement, the statement of changes in stockholders' equity, and the statement of cash flows. There are the four basic financial statements. Plus, attached to them are footnotes. Footnotes are explanations of items in the financial statements that need additional clarification for the reader to totally understand what has occurred in the financial statement themselves. It will explain such things as the methods of depreciation, the methods of valuing inventories, the breakout of the corporate debt and when it's due, a discussion of any leases that the company may have, things of that nature. So briefly, I want you to take a minute and leaf through the various statements and particularly look through the footnotes, because these are a critical part of the financial statements and understanding the financial statements themselves. The auditor's opinion is issued based on the financial statements that you are reading. They have examined the books and records of the company and are giving their opinion about the fairness and accuracy of those financial statements. In this particular situation, the company is receiving a clean opinion from their auditors. They're saying that the company's records and financial statements properly represent the books and records of the company, and they can be relied on for their accuracy. Now, auditors may also issue other types of opinions. For example, they may deny issuing an opinion if they're not satisfied with the books and records. An opinion of this type would be a nail in the coffin of the corporation as far as it is concerned, because the investors would immediately sell their stock and the company would be sliding quickly toward bankruptcy. Or they might issue a qualified opinion where they like everything about the financial records except one particular thing. Maybe they disagree on the valuation of inventories, or maybe they disagree on the way the company is treating a particular acquisition, things of that nature. But 99.9% of the opinions you will see on publicly traded companies have a clean opinion. What is GAAP? Generally Accepted Accounting Principles. You will hear this term over and over. Somebody will say, well, that is not GAAP, or that is GAAP. Well, they're talking about the accounting principles that are being applied. Basically, the accounting principles are a collection of concepts, guidelines, and principles and rules that have been applied in preparing financial reports. And this is a culmination of a body of knowledge that goes back 50, 60, 70, maybe even 80 years. And it does change over time. In other words, as we work forward, some of the concepts change because the way we do business and the legal ramifications may change these. So let's talk about the rule-making bodies. Where do the generally accepted accounting principles come from? Well, the primary source of this information comes from FASB, the Financial Accounting and Standards Board. The Financial Accounting and Standards Board was organized in 1973 by the accounting and profession, along with the government, along with the financial institution, bankers, and so forth. Prior to that, the rulemaking bodies were primarily vested with the American Institute of CPAs. But at that time, bankers, accountants, lawyers, so forth, felt they wanted an independent standards board that would lay out the accounting rules. And to date, they have issued some 225 rulings that become actually law as far as preparing financial statements. I mentioned the statement of cash flows. That was actually FASB number 13 that brought about that particular statement. The second rulemaking body is the Security and Exchange Commission. The Security and Exchange Commission governs the way in which public companies report their information to the public. And they also may issue rules and guidelines that must be followed by the public companies and their auditors in preparing financial statements. Recently, we have started hearing about what we call IFRS, IFSAS, International Financial Accounting Standards Board. This board sets the accounting rules and regulations for companies worldwide. And many of your companies in Europe and other parts of the world use these pronouncements to prepare their financial statements. This is not true of U.S. companies. They may comply with the Financial Accounting Standards Board in some conditions, but they still must rely primarily on FASB in preparing their financial accounting standards. There are a group of people within the accounting profession who believe that ultimately the IFRS will replace the FASB as a rulemaking body. In my opinion, that's a long way off, but there's a lot of good information in the IFRS rulings that would make the financial statements much more readable if they were used. The last rulemaking body is the American Institute of Certified Public Accountants. Prior to 1973, they were the body that issued most of the accounting rules and regulations relative to accounting and auditing of financial statements. Most of their duties have now been taken over by FASB, but they still occasionally are involved in the rulemaking situation and do feed information, concepts, and input to the FASB board. Let's talk about the types of accounting principles. We have the rule-based principles such as FASB and the Security and Exchange Commission. These are written as rules. In other words, these rules must be followed to the letter and complied with by publicly traded and private companies that are audited. Prior to FASB, most of our accounting principles were judgment-based. They looked at what was reasonable and rational and applied those to making decisions as to how financial information should be presented in the financial statements. This is a little bit of a form versus substance problem as far as rule-based accounting is concerned. When you looked at the judgment-based type of principles, it was open to discussion and as to whether the item was presented in a reasonable and rational fashion. When it's a rule-based type of thing, you look and say, is the item follow the letter of the law? Now, the problem with this, once you have a law or a rule, people will find a way to circumvent that rule or law or find a way to apply it, which on the appearance appears to meet the terms of the rule, but basically does not if you looked at the substance of the presentation. Enron is a perfect example of the abuse of the application of FASB regulations. In many cases, if you looked at the Enron statements, they complied with the FASB rules. But if you looked at the substance behind them and the contortions that were taking place in twisting the application of these rules, you'll find that there was a mass distortion, which ultimately brought down the Enron Corporation as well as a number of other companies in the early 21st century. Let's talk about some fundamental accounting concepts. Accounting period. There is assumption that when we're looking at a financial statement, it relates to an accounting period, a month, a quarter, a year. Also, when you look at the balance sheet, everything is stated at historical cost. It's what the company paid for the item, not what the market value of the item is today. Now, there are a few deviations from this. For example, in the case of marketable securities are revaluated at the end of the accounting period. But this is a very small exception to the cost principle. There is the equity concept, that there is a corporate organization, a partnership, or a proprietorship involved. There is a business entity that relates to the financial information. When you look at the financial statements, there is the assumption that the organization is a going concern, that is going to operate in the future. Also, there's concepts of revenue recognition and expense recognition. When we talk about expense recognition and revenue recognition, we're talking about the accrual versus the cash basis of accounting. We also have cycles. The accounting cycle refers to the accounting period, the year, the quarter, the month. When we talk about an operating cycle, we talk about the time it takes from the point that cash is expended to buy merchandise until it is converted and sold, and then becomes an accounts receivable, and then is converted back to cash. In other words, it is a cycle during which the cash is expended and ultimately converted back to cash again. And we will talk about this when we look at inventory, accounts receivable, and things of that nature. Now I want you to look at the exercise and complete those problems, and then come back once you're through with those, compare them to the recommended solutions.